There are thousands of books, courses, YouTube channels, and Reddit threads about investing. And yet the majority of people who consume all of that content still can't answer one basic question. What am I actually buying? Not, is it a good buy? Not, will it go up? Just, what is this thing? Mechanically, at its core. But by the end of this video, you will know exactly what every major asset class actually is. And I promise you, at least two of them are going to reframe something you thought you already understood. Let's start with stocks, because everyone thinks they know what a stock is. And most people are about 60% right, which is the most dangerous place to be. The mainstream explanation is simple. You buy a stock, you own a piece of a company does well, stock goes up. Clean, tidy, satisfying. But here's where that explanation starts to break. When you buy a share of Apple, you don't own Apple. You own a claim on Apple. Specifically, you own the right to a proportional slice of whatever is left over after every single other person gets paid. Employees first, debt holders first, the IRS definitely first. You are last in line, always. And that line is very long. So why does anyone buy stocks? Because that residual claim, the thing left over at the very end of the line, can be enormous. Because companies that grow compound their earnings over time. And compounding is the only force in finance that genuinely defies intuition. A company that grows earnings at 10% a year, doubles them every 7 years, double them again in another 7. That's not magic. That's just math working in your favor, slowly, and then all at once. Stocks are not lottery tickets. They are not savings accounts. They are ownership stakes in productive human enterprises, with the legal right to nothing until everyone else is paid. That's the honest version. A bond is debt. You are the bank. You lend money to a government or a corporation, and they agree to pay you back with interest on a fixed schedule. That's it. There's no upside beyond what was agreed on day one. The company could 10x its profits while you're holding the bond. You still just get your coupon. The upside of that? You're no longer last in line. Bondholders get paid before equity holders. If a company goes bankrupt, shareholders often get nothing. Bondholders often get something, which in bankruptcy is basically a miracle. The practical implication? Stocks are for growth, bonds are for stability. And the reason your grandparents' financial advisor kept telling them to hold more bonds as they got older is because retirement is not the time to find out you're last in line. And this is where index funds enter the story. An index fund is not an investment, not really. It is a mechanism for holding investments, specifically a basket of stocks or bonds designed to mirror a market index, like the S&P 500. Here's how it worked. Meet Bob. Bob is a financial economist in 1975, and Bob had a problem. He looked at the data on actively managed mutual funds, the ones where a very expensive human being picks the stocks, and he noticed something uncomfortable. Most of them underperformed a simple market average, after fees, over long periods of time. Not occasionally, consistently, the majority. So Bob asked, what if you just bought the whole market? No manager, no fees, no stock picking. Just own everything proportionally forever. The result was the index fund, and it is statistically one of the best investments available to normal people. Not because it's exciting, but specifically because it isn't, because it removes the single biggest variable that destroys long-term returns, a human making emotional decisions with your money. Real estate is interesting because it is two completely different investments wearing the same trench coat, pretending to be one. Investment 1. You buy a property and rent it out. This is a cash flow play. You are a landlord. You are a small business owner. You have tenants and repairs and mortgages and vacancy risk. The asset pays you because someone else uses it. This is not passive income. This is a job that you own. Investment 2. You buy a property and wait for it to appreciate. This is a capital gains play. You're betting that the land and structure will be worth more in the future because demand in that area grows faster than supply. This works in cities with restricted land. It does not always work everywhere, despite what your parents told you about houses always going up. They grew up during one of the most anomalous real estate environments in American history. The thing that makes real estate uniquely powerful versus most other asset classes is leverage. A bank will lend you 4, 5, 10 times your money to buy property because property is physical collateral. You can control a $500,000 asset with $100,000. That amplifies both your gains and your losses because leverage is just a multiplier. It doesn't discriminate between directions. Commodities are the oldest investments on the planet because you're buying physical things: oil, gold, wheat, copper, things that exist in the ground or grow from it. The reason people invest in commodities is not because they want barrels of oil in their garage. It's because commodities are upstream of everything else. Before there are products, there are materials. Before there are materials, there are commodities. And when commodities get expensive, when oil spikes, when copper gets scarce, every business that touches those materials gets squeezed. This is why commodities are historically the best hedge against inflation, because inflation at its mechanical core is often just a commodity price story that hasn't finished trickling down yet. Gold specifically deserves a single sentence of honesty. Gold pays no dividend, produces no earnings, and generates no cash flow. People buy it because they believe other people will always want it. That is a belief system, not a business model. It has worked for 5,000 years. Make of that what you will. Crypto, the asset class that makes everyone emotional and nobody calm. Here's the mechanical version stripped of the ideology. A cryptocurrency is a digital asset that lives on a decentralized ledger, a blockchain, that no single entity controls. It wasn't X, it wasn't Y, it wasn't issued by a government, it was created by code running on a distributed network. That's the structure. What gives it value? Depends entirely on the coin. Bitcoin's value proposition is scarcity and network effect. There will only ever be 21 million, and more people want them over time. That is a store of value argument. Ethereum's value proposition is utility. It's a programmable network that runs smart contracts. That's a technology argument. Both arguments might be correct. Both might be completely wrong. The honest answer is that crypto is the only major asset class where it's worth what people believe it's worth is the entire fundamental case. Because unlike stocks, there are no earnings. Unlike bonds, there is no guaranteed repayment. Unlike real estate, it has no physical utility you can rent. The price is purely and entirely a collective bet on future demand. That's not a criticism, it's a description. Know what you're holding. Now, private equity is the one that quietly runs a significant portion of the economy, and most people have genuinely never heard a clean explanation of it. Here's how it works. A private equity firm raises money from large institutional investors, pension funds, endowments, sovereign wealth funds, pools it, borrows additional money on top of that, because there's the leverage we promised, and then uses the combined pile to buy private companies outright. Not publicly traded companies, private ones. Then they own and operate those companies for 5 to 7 years, usually cutting costs, restructuring operations, sometimes growing them, sometimes loading them with debt that the company, not the fund, has to service. And then they sell. To the public market in an IPO, or to another private equity firm in what the industry tactfully calls a secondary buyout and what everyone else calls passing the bag. The reason this matters to you specifically is that if you have a pension, a public sector retirement account, or a university endowment, you are almost certainly already an investor in private equity. Your retirement money was pooled, handed to one of these funds, and used to buy and restructure private companies. You had no vote, you had no visibility, and you definitely didn't get the 20% carried interest the fund manager collected. So what have we actually established? 8 asset classes, 8 different mechanisms, and not one of them is simply put money in, get more money out. And I'm sure you've likely heard buying a home is the best financial decision you'll ever make. It's definitely not. Click this video on the screen to understand why.